But it's lovely to be here. My name's Marty Connaghan, and Ben, how many presents? How many slides? There we go. So I work on Murray International Trust, which is a large global equity income trust. So at the complete boring end of the market, but for every exciting fund that we have, you need something to balance that, and that's where Murray International comes in. So say the investment objective is to deliver an above average dividend yield, which is about 4.5%. We look to earn that dividend from the underlying holdings of the portfolio. We don't cover it out of capital. And then we look to grow the capital and the income in real terms over the long term. And it's really as simple as that. You'll notice I didn't mention a benchmark. There is no benchmark. There is a reference index. But in delivering that investment objective, you would be quite foolish to expect to keep pace with a global benchmark, which has got about 60% in the United States and a healthy allocation to non-dividend paying companies. So I just leave that alone. We forget all about that and we focus on the investment objective. We've grown the dividend for 19 consecutive years. We have grown the dividend ahead of inflation in 15 of the last 20 years. Obviously, inflation in the last couple of years has been quite a tricky hurdle for us. And, the total NAV return has been 10% annualised in sterling over the last 20 years, I beg your pardon. And if you think about, on the tech side and the returns of Ben's fund, delivering higher returns, which it should given the allocation. But this is just something different that allows you a different opportunity, allows our friends at AJ Bell a different opportunity in allocating to for their clients. It can deliver a very reasonable level of return, but without ever holding any of the Magnificent Seven or these AI-related stocks. Nothing wrong with those businesses, but if this fund over here is investing in them, and this fund over here is investing in them, and I'm investing in them, and you're investing in them, we think we're diversified because we've got 6 or 7 or 8 different funds, but in reality we're not. So for every technology fund, we think that there is a place for an income allocation in everybody's portfolio. And that's really all we're trying to do with Murray International. Performance to the half year, it's been okay. UK, top of the pops, that never happens. Thought the UK market was done. 41 months of negative flows to UK equity funds. 41 months. It was £1 billion sterling last month. But there are still very, very reasonable businesses within the UK market, and we look to allocate to them. North America up 16%. Most of that driven by a number of the technology companies that Ben himself also invests in. We invest in Broadcom, for example, because it does give us a level of yield that we can work with, which is 1.5%. We can invest in Nvidia. The level of dividend yield just isn't there for us, but again, that's fine. We just leave that alone and focus on companies that pay us a level of dividend that we can work with. Asia, got about 25% of the fund in Asia. And again, that's been very driven by technology stocks. Stocks like TSMC, stocks like Connaghan in Asia, again, getting caught up in the AI theme, but where we can also get a level of income that works for us. We're also always going to get things wrong in the portfolio, or things aren't going to be going up, all up at the same time. And again, that is okay. Our Latin American investments have been pretty weak this year. People often ask us why we bother with Latin America. So I've been involved with equity markets since 1998. So we're just coming on for 27 years. If we were to take the subcomponents of the FTSE World or the FTSE All Share and break it down into its regional component indices, how many times, or what would be the best performing market the most times over those 26 years? And if you're thinking the answer is North America, it's not. This is a horrible chart, but it's Latin America. 11 times it's been the best performing market and actually has a better return on an annualized basis than the United States. Very well-run businesses in Latin America, and a lot of people ignore it. Yes, the US is a great market. There are great businesses in the US, but other markets and other companies are available. So again, we're just really trying to offer something a little bit different in terms of our allocation. Look at the UK. What's going on? Not once, not since 96 has it been the best performing sub-region of a global benchmark. That's really, really disappointing. But again, we should not ignore the UK market. There are very, very well run and capable businesses within it. Some of the stocks that have been weak, some of the cyclical areas of the portfolio have been disappointing. Commodities, with the exception of copper, gold and silver, have been pretty weak. China's weighed on the iron ore price, and that's dragged down a number of these companies. But for us, the dividends are still there. We understand that they're cyclical businesses. We take that into account with the allocation, and we allocate capital accordingly. There are always going to be areas of the portfolio are weak, and that's fine. That's the opportunity for us to take money off the stocks that are performing well and add capital to the ones that are. On the flip side, as mentioned, we can and do allocate to technology where we get the level of income that will help us. And stocks like Foxconn, TSMC and Broadcom have certainly been delivering in that front. Just wanted to talk a little bit about the positioning. It is a balancing act for us. We do want to deliver income. Over the long run, fixed income can take up or make up about 50% of your overall total return over the long term. So going back to that earlier slide, the reinvestment of dividend income is a very, very important compounder. And where we can have a balance, we will have higher yielding stocks in the portfolio. We need to have higher yielding stocks in the portfolio. But where we can get lower yielding companies that pay us a reasonable enough dividend, then we will have an allocation to them. So it's that balance of income and capital, growth and value, diversification right across the board at the company level. Geographical diversification. Most global funds that you tend to look at probably will have getting towards half, if not more, in the United States. That's fine, but there are other companies in other parts of the globe, so we have a more balanced approach to that asset allocation. Quite a small allocation to the UK, 6-7%, but sizable and comparable allocations to Asia, to Europe and to the United States. And we still do allocate to Latin America for the reasons on the other chart, and that the level of return that you can generate there if you get it right. We don't have anything in Japan at the moment. That's not that we're negative on Japan. It's just that when we stack the companies that we come across there, we either find that the consistency in dividend payment or the level of yield is not where we would like it to be, or where we do find that, we just find that they don't stack up either on a valuation or a quality basis. And again, for us all being sterling-based investors, you have to very much take into account the impact of the Japanese yen. And the Japanese market tends to be very strong. It's more often than not because the yen's going in the other direction. So you always have to keep that in mind. Sector-wise, again, very well diversified. We can invest in technology and do it to about 20%, but right across the other areas of the market, telecommunications, staples, healthcare, financials, everywhere. Real diversification, looking to generate and diversify the revenue stream as well as capital growth. Our outlook, the easy bit, the really, really easy bit. Discounts have been, a real issue for the industry. A number of trusts have been trading at discounts. Murray International has traded at a premium at times. We issue stock when we trade at a premium, and we buy stock back when we go to a discount. Discounts have actually been quite wide. I genuinely believe that, not just for Murray International, but for a number of stocks and a number of funds, that the underlying holdings are just a large basket of listed equities. If you can buy that for a discount, I think that's a real opportunity for investors. And I think that the investment trust industry will come back. Murray International has been around since 1907. It's been through uncertain times in the past, and a number of trusts will continue to do that. Capital preservation. We are not going one of the vehicles that if the market's up 20, this is going to be up 25. That is not what Murray International is. Murray International is a trust that if the market was down 8%, which it was pretty much in sterling terms in 2022, this trust was up 8%. Now that's what it's for, is to preserve capital on the downside, deliver some of the upside, but nowhere near all of it. Again, other funds are available that will do that for you. That's what you allocate to a tech fund or a private equity fund. And this is an income fund that's there to provide income and be that defensive ballast within the portfolio, which we all need. Some of the scenario analysis that we were looking at. Where do we start? I think it says a lot that we've got 3 different outcomes as it relates to Donald Trump. That really just says it all. Basically what we're saying with these slides is that we don't really know. A soft landing in the UK. There's going to be a soft landing in the US. There might be. There might not be. We don't really know. You know, talking about the SAM reel with regards to unemployment, the market got itself in a real tizzy with a jobless number, a couple of months ago, and now it's back at all-time highs. Making any sort of investment based upon any of this really isn't what we waste any of our time doing, because if we were being brutally honest, the answer is we don't know. Likewise, with the Middle East, we have to take these things into account. We have to be mindful of them. But basing any investment decision based upon solely a view on this isn't what we waste our time doing. You could get yourself in a really, really dark place by continuing to think about these big issues that are facing us all. What's Trump going to do? Trump doesn't even know what Trump's going to do. What's going to happen in the Middle East? I have no idea. What's going to happen in Russia, Ukraine? I have no idea. What's going to happen between China and the US? We have no idea. You could put yourself in a really, really dark place if you think about the level of debt in the United States that nobody wants to talk about. You know, the last time the US was in that amount of debt relative to GDP post-war, corporation tax was between 40 and 50%, and highest rate tax went to 90%. I didn't hear Trump or Harris talking about that sort of policy during the campaign. They don't want to address these issues. Again, all of these things are things to be mindful of. What's going to happen in China? Who knows? More stimulus. What really matters is where the stimulus is aimed, not how much they're going to throw at it. Where are they throwing it? That could well improve sentiment, but basing an investment decision off it isn't really what we spend our time doing. The main reason what we do spend our time doing is going back to what the investment objective is, because that's when things become a lot more straightforward. The investment objective of Murray International is to deliver an above average dividend yield. To cover that dividend from a portfolio of 40, we've got 47 stocks in the portfolio at the moment. If I get myself, forget about what's going out externally, which I have no control over, which nobody in this room has any control over. How do I deliver that investment objective for shareholders? This isn't my investment objective. It's not the board's investment objective. Shareholders set the investment objective. And all we have to do to deliver that investment objective is to find 50 businesses, good quality businesses that we think will have sustainable and growing dividends, and that will be bigger businesses than they are at the moment in 3, 5 and 10 years. And if we think of things in that term, then it becomes a lot more simpler. Then things become a little bit more easier, and then you can sort of talk yourself off the ledge. That was all I was really going to say about Murray International. As I say, focus on the investment objective. Ask yourselves what your own investment objective is. Don't deviate from that. Focus on the controllables. You can make this business a very, very complicated business, and it doesn't really have to be. You can find understandable super trends like AI. You can find yourself the simplest business in the world. Invest in it. Invest for the long term. I also agree with the point made earlier about don't trade excessively. We have a very, very low turnover approach. Low turnover shouldn't mean no turnover. You shouldn't just trade for trading's sake. Some people would say that that's because I'm a Glaswegian and I'm very, very tight and I don't like paying broker commission. There may well be an element of truth to that, but I do believe in the sort of buy and hold, stick to your knitting. We won't deviate from what we do. That allows you to make fully informed investment decisions. That allows our colleagues at AG Bell to make fully informed decisions and understand what this trust is and where it may or may not make sense for our shareholders and our prospective shareholders. I'd just like to thank you all for coming along. Thanks to AJ Bell for having me once again, and hopefully catch up with you all a little bit later on. But thank you.